Hindustan Zinc has reported weak but in-line set of numbers. There have also been delays in certain projects which were supposed to be commissioned in Q3 FY20. But joining us to know more about the financials of the company is the CEO, Mr. Sunil Duggal. Hello and welcome to BloombergQuint, sir. Hi, this is Nikki. I'm going to start off by asking you about the performance that we've seen, especially with regards to the zinc cost of production. Now, that number has been steadily on rise. We've seen a 6% rise year-on-year basis. What number do you expect the FY20 to close by, and what's the sort of reduction that can be expected for FY21?
So, if I would come quickly on what has happened in quarter 3 compared to quarter 2. So, our mine metal production grew at a percentage of 8%, and our finished good production also grew, and silver production grew at a growth of 11%. As you are saying, the cost of production in the quarter 3 was $1077 compared to a prior quarter of $1048. So there is not hardly any cost increases there from quarter 2 to quarter 3. If we look at why the cost has gone up, we have principally focused on mine development to lay on the fundamentals of the mine, where we have entered into the good grades, where the overall average grade of the mine metal across the organization will go up. So we brought good operators from China, Peru, Australia to have a fast development in our mine. So this lays the fundamental. So this was the principal reason of the slight cost increase. Our own belief is that we will be ending the year with a cost of around $1,000. So we will be able to reduce the cost from quarter 3 to quarter 4 by around $70-80.
All right. The reason why I asked you this question was because in the last 2-3 years, if you go back, take a step back and see, the cost of production has been in the range of around 50 to 55,000 odd rupee per ton. And this time around, in the last 2 years, we've seen that number rising to 76,571 crore, 70 per ton. I would like to understand with the new projects which are now kicking in and the few rationalization measures that the company has been undertaking, overall for FY21 in the larger scheme of events, how do you see the cost of production now working out? You've already spelled it out for quarter 4. What is the guidance that you'd like to give for FY21 for that matter?
So, first I may tell you that we look at the cost in dollars because we are driven by LME and the prices of zinc are driven by LME, and our cost also has a lot of bearing on the rupee versus dollar. So we always look at the cost in dollars. So as far as the cost for the next year and next few quarters is concerned, one is that we had the temporary setback of the geotech issues in a couple of our mines where we had to mine from the low grade, so which was a temporary phase. This phase we have almost come out, and that is why I said that we will have a much robust and better volume in quarter 4. The volume will be able to control the cost, number one. Number two, there are a lot of structural measures and the completion of the project giving us the opportunity of lowering the cost. The shaft at Rampura Gucha is up and commissioned. The final phase of the ore pass from dropping the ore from the ore body to the shaft is in the final stages of the completion. So we will commission the shaft in the next 1 or 2 weeks' time. Although the shaft is running up with the waste now, this will give us the opportunity of reducing the hauling cost from the mine, which is a big boost. Another is that another phase of the project completing at Zawar, where the 2 paste fill plants are getting commissioned. This will give us an opportunity to mine from the higher level of the mine where we have the developed pillars, and we'll be able to get hold of the low-hanging fruits for the next few years, where the grade is also high and there is no development involved. So these are the two things which are happening in the mine. But apart from that, there are, the digitization efforts going on. The digitization in SK mine and Rampura, which is completed to the extent of 60 to 70%. This completion of digitization should give us a efficiency, productivity, and OE improvement of 10 to 15%. So this will directly result into the reduction of the cost. Apart from that, as I have been saying earlier, that there are a lot of efforts in terms of the minor metal recovery from our mine metal. So there is a total opportunity of 1,000 crore. Around 150 crore opportunity projects are completed. Other projects are in pipeline. In the next 1 year or so, when these projects will get completed, this will give us an additional realization of 1,000 crore. This will give a total credit to the cost. So the overall cost structure will come down.
Sure. This is going to be a two-part question, and also the first one is going to be a follow-up. I'd like to understand, you said that the digitalization efforts that have been taken, 60 to 65% completion right now, would lead to a cost reduction to an extent of 10 to 15 odd percent. When would that reflect into financials, A? And the second question that I have for you is with regards to the outlook that you have for the zinc market overall, because right now we're in the deficit of only 500 KT. Most of the brokerages estimate that the industry will return into surplus situation. What's your take on this one?
So first, on digitization effort, as I said, that the work is almost completed and in a final phase. This will enable us to run the machine remotely from the surface, and during the changeover hours also the machines will run, and the total digitization, the laying of the network underground is almost complete. So this benefit we will start seeing in the next couple of quarters in the cost. As far as the zinc outlook is concerned, let me tell you that we had certain prediction at the start of the year that the mine metal production will grow at the rate of 6%, but actually it grew at a rate of 2%. So it was not able to fill up the deficit to the extent it was expected. And as a result, the LME stocks, which were 4 to 5 days, have fallen down to 2 to 3 days. In absolute term, these stocks have fallen from 100 KT to 60 KT. So the deficit has gone up, actually speaking, as far as the finished good is concerned. So with these stocks, which are historically low, any small activity or any boost in economy anywhere in the world will give a kick to the LME prices, and the LME prices could shoot from there. Let me also tell you that in the last 5 years, if we see at a CAGR growth of the demand, the global demand has grown at a CAGR of 0.6%, while there was a degrowth in the finished good or the zinc metal, which was at a minus 0.3% for the last 5 years. So the fundamental still remains strong.
I get your point. With that, you're trying to conclude that zinc market is expected to remain in that deficit situation and is not expected to come into surplus situation anytime soon. But my next question to you, is with regards to the premium, because the zinc premium have been under pressure in the last 2 quarters. In this quarter, it was down by more than $25 per ton. What explains this, and what can we expect going forward?
So, people were trying to optimize their working capital. So the big players, our own experience is that during the last quarter, the big players were trying to optimize their working capital, and with that, the temporary offtake at the end of the quarter was not visible. So with that, there was a pressure on the premium, and there was a temporary fall of the premium of $20. That was a spot premium, I would say. The long-term premium remains same, because 80% to 90% of our the sale goes through the long-term contracts.
like to understand about your capex plan, because right now the growth the growth capex is to an extent of $300 million. I'd like to know about your sustenance capex, which should be over and above your growth capex. How much is that? If you could quantify that number for FY20 and 21 as a whole.
21, I will not be able to say because we are on a drawing board and planning our business plan. And as far as the FY20 is concerned, we will have the sustaining capex of around $250 million.
Mr. Duggal, the last question that I have for you, is regards to the input pressures, if at all. The coal prices outlook specifically, because the linkage coal prices are higher than that of the imported on landed basis. Where do you see that price? If you could give us a direction by the end of FY20 or 21 for that matter.
So I don't think the linkage or the domestic coal prices will rise in the time to come. Today also the landed imported coal prices 1 or 2% higher compared to the linkage. Of course, compared to last year, the linkage prices have gone up. With the coal mining opening up, the commercial coal mining opening up, and the availability of the coal and the good grade coals going up, the landed price in fact should be at par with the global prices. Global prices, remain fluctuating as per the global condition, but we remain more comfortable with the domestic prices and linkage prices because this gives us the visibility of our plan for the next year or so. I don't think the domestic landed prices are going to go up. In fact, these prices will come down as the commercial mining starts.
All right, Mr. Duggal, we'll leave it at that. Thank you so much for taking out the time and speaking to BloombergQuint.
Thank you.